Welcome to Voyage Investing, navigating the financial market. Before we begin, I'm just going to go through quickly the ethos of Voyage Investing. This is a new channel. So to all of viewers, we promise that we're going to create content that helps you navigate the financial markets. There's absolutely going to be no hypes or clickbaits. Also, disclaimer, this isn't financial advice. You have to do your own research. Okay, so the topic today is the stock market frothy or overvalued? Here's an interesting article from Wall Street Journal which says that the tech influence over markets eclipses the dot-com bubble. Meaning to say, if you remember in 1999, there was a stock market bubble, and we know what happened subsequently. It was a big crash, the dot-com crash. At that time, the tech portion of the S&P index was 40% in terms of ratio. What this article is saying is, there is 40% today in October 2020, October 16, 2020. So the implication being that there may be another crash. So that got me thinking, how do you say a market is overvalued or not? Not only in terms of today, historically, how does it compare to stock markets elsewhere? Compare US to the UK, to Singapore. So how do you measure that? So that we need to think about, right? So here we have the 2020 performance from S&P 500. If you look at it, you see Apple, Facebook, basically the FANG stocks really doing really well. And if you look at Apple, it's not a feat to have that kind of growth, especially considering it's almost a $2 trillion company today. So Facebook, Alphabet, the same, right? However, if you look at S&P 500, hasn't proportionally gone up in the same level. So how do you do a relative market valuation? So it's a relative thing to do. So there is something called a Buffett indicator. It basically says it's a measure that you can apply to say how is the market doing relative to other periods in our history. So it's really a ratio between the total market cap of a given country to its gross national product. If you look at the US, the total market cap today is approaching 41 trillion. GNP is 20 trillion. That gives you a Buffett indicator about 200%. Like I said, this is really a ratio. It's a relative measure. It doesn't tell you anything to before or after. So what does this actually mean? So if you look at it, historically, it's a graph showing the Buffett indicator going back to 1950. And if you look at this historical trend line, it's slanting upwards a little bit, and there is fluctuations going above and below that. And you can see during the dot-com crash, it was the difference between the trend line and the peak was around 71%. Okay, and today it's about 67%. It's almost the same, very similar to what was in the dot-com bubble. So the implication is that we know what happened immediately after we took a big dive, right? Would that happen? Is that the expectation now? Is that what's going to happen as a result? That's really the big question. So normally, the Buffett indicator, what this actually means. If it is less than 70%, the ratio, it's undervalued. If it's more than 135%, it means overvalued, right? So if you look at that, Today it's almost 200%. It is 71% higher than the historical trend line. So it's significantly overvalued if you believe that. If you believe that Buffett indicator is a reliable measure of the valuation of the market, it clearly says, okay, well, this market is significantly overvalued. So what does that actually mean for the future returns, right? If you have an overvalued market, and over time, if you believe that the valuation has to come back to the trend line, what does that mean, right? So if you want to look at it objectively, an investment return is the sum of the dividend, the business growth, and the change in valuation. So dividend, I think you know the story, that's not going to go up anytime soon. Airlines, banks, they're all forced to cut their dividends for the foreseeable future. Business growth is a tricky one because some businesses are growing like crazy, especially the software as a service businesses. But others are not. They're languishing, right? The restaurant, the travel industry, etc. And also the change in valuation. I think this is the one that is really important, because today what's happening is the valuation of the same stock is going up by a lot when the fundamental has not changed so much, in the sense that the valuation is disproportionately going up compared to the fundamentals. Okay, so if you believe in the Buffett indicator, which says 70% of GDP is the normal valuation of the market, that means we are in for a crash, huh? But there's nothing, we cannot look at the future, so we cannot really tell if the Buffett indicator is also a reliable measure for 2020 as it was for 2010, as it was for 2000, etc. So now here's an interesting chart that talks about the what the Buffett indicator means to all of these different markets, right? It says Singapore has an annual return of 16.4%, means if you apply the Buffett indicator to Singapore, it's significantly undervalued and it's going to give you 16% returns. Spain will give you 13% returns based on the Buffett indicators applied to the Spanish stock exchanges, right? And if you go down this list, you see USA at the bottom at minus 3.3%. So over the next 10 years, you're going to get a minus 3.3 return if you believe the Buffett indicator applies today. Okay. Also, you look at other emerging markets like Turkey, 17%, Indonesia, 14%. This is not to say that you should sell your stocks right now. That's not what I'm trying to tell you. What I'm trying to tell you is, if you believe in the Buffett indicator, this is what it suggests. Okay, but Buffett indicator is not the only measure. There could be other factors that are different today than it was, let's say, in 1999. Let's really look at, so let's make a deep dive and see what's actually going on in especially S&P 500 in the US markets. If you look at that, you see that the red dots here, which are the technology portions of the S&P 500, they were about 40% in 1999, and they're back to 40% today. In 2008, they were less than 20%. So their proportion value of S&P has almost doubled. This indicates, could indicate they're significantly overvalued, that they've doubled in value, or it could also mean that the technology has captured so much value that the doubling is justified. So we will look into that in a little bit more detail. But that's what it says. So when you say the market is overvalued, it's not a broad, it's really a broad statement. But if you look inside the hood, you see, for example, energy has dropped significantly compared to 99. Utilities, there's no wonder they call it a defensive move, owning utilities, because they hardly move up or down, right? It's almost a straight line from 2000 to here. So they track, basically a horizontal line. So you can look at all of these different categories and see how they've done. So even the banks had gone up in 2008 and they've gone down. So you see the banks are under is the same level as in, or maybe slightly less as it was in 2000. But this is not the only measure. A Buffett indicator is not the only measure of valuation. Let's look at another one. It's called the Schiller P. Basically, when you look at stocks, you look at the price earnings ratio, and Schiller PE measure looks at the price of all of the stocks and divides it by the normalized earnings. So you just smooth out the earnings over a period of time, adjusted for inflation, and then that ratio will give you how the price was relative to the earnings at that time. So here's an interesting graph going back to 1880. This is 140 years. So if you look at that, in the 1930, the price to earnings was close to 30 before the market crashed. There were other crashes in the 89, I think this was 87 or 88. It was much less. And today it's 31. But it's still low compared to the dot-com bubble when it was 45, right? So what does that mean? Does that mean that we could still go a bit higher to 45 before we come down? Or is 31 the peak? That is the value judgment or the probability assessment that we need to make, right? So there are factors, because what's 99 is very different to 2008, is very different to now, right? Let's look at why somebody will pay you a higher price earning multiple depending on the period you're in. I think it's broadly a function of how much money is in the market, right? So how much money is in the hands of investors, like institutions, because all of those money eventually will go into the stock market, right? Through different means, they will all end up in the stock market because everybody is chasing returns. So let's look at this. This is an explanation that almost tells you counter to what the Buffett indicator is saying. The market could still go up. I'll try to explain why. So if you look at this is the interest rate. This is the Federal Reserve balance sheet. And as you know, Federal Reserve is a central bank, and it provides, it's the lender of last resort, and it lends money to the different banks in the ecosystem, who in turn lend them to like corporations, buy different assets, and in the end they'll all end up invested in the stock market or the bond market or the property, right? So this is the source of, this is actually a measure of the amount of money that is in available to investors. And if you look at here, today we have interest rate 0, and they're going to stay 0 for the foreseeable future. That's what the Federal Reserve Chairman has already declared. But beyond the rates being 0, because stock market is usually inversely related to the interest rates, because if the interest rates are high, the value of the value to borrow the money is higher, the cost to borrow the money is higher, and therefore there's less money, right? So with the interest rate 0, it means that the Fed cannot do anything else, right? So it's already 0. So what they have tried to do in low interest rate environments going back is really to try to do what is called a quantitative easing. So what they do is they try to buy an asset, usually an asset that has gone down in value or in trouble, and actually replace that with cash. So for example, if a bank has an asset that is not performing well, the Fed will take that asset and give the cash to the bank, right? So what it does is basically refreshes the balance sheets of the banks or other institutions, allowing them to spend again. So they become liquid again, and they can do their business. So if you look at what happened in 2008, the Fed balance sheet was around 2 trillion, something like that. And the curve is steadily the blue line. If you look at that, 2008, there was QE1, 2, and 3. So there were programs by the Fed that took assets, different types of assets, right? Initially, it was the treasuries, mortgage-backed securities, which was because it was a housing market crash, right? So they took the housing market loans out of the banks and replaced them with cash. Then it was treasury securities and so on, right? So it went up, and then they started around 2015-16 to unwind some of the assets, and they were starting to do that around 2018 actually, and then they were trying to do it until we got the coronavirus pandemic. And you can see from here, ever since the coronavirus hit, the Fed's balance sheet has almost doubled, right, from around 4 trillion to now it's about 7 trillion as I speak, October 2020. But it's forecasted to go up even higher. So what does that mean? That means if you compare January of 2020 and now October of 2020, in a few months we had almost $3+ trillion in cash going to the institutions, becoming more available. So where does that end up is another question. So most of that, I think about 30 to 40% of that has ended up in the stock market, because if you look at the valuations, it's really shows that that money, extra money, will somehow end up in the stock market. Not all of it, but a good proportion of it. And it is he's almost uncanny correlation. If you look at the orange graph, which is basically the S&P chart going back to 2008, as the Fed has increased its balance sheet, the S&P is basically gone with it, right? So if you can see here, now with this increase in Federal Reserve balance sheet going up to 9 trillion in the next few years, if you were to just follow this graph up, follow the Fed balance sheet expansion, it indicates, nothing's guaranteed, but it indicates that it could still go up a little bit. Okay. Now, let's look at some of the valuations. It's, as you know, some of the valuations are absolutely crazy. It doesn't mean they're still gonna go up higher, but let us just look at what, when we say expensive, how expensive it is. So here, I'm looking at the enterprise value to 21, 22, 21 revenue of the SaaS companies. That's software as a service companies, basically tech companies, cloud-based service companies that are growing really incredibly fast. Some of these are growing over 100% year on year. So there are a lot of the traditional, traditional software, they're moving to the cloud. There's a lot of digital transformation happening in the world, and it's accelerated because of COVID. So these companies are really growing very fast. So it's not like any other period in history. It's growing really fast based on something that is underlyingly, something underlying that supports the growth, right? Because they are growing this fast and they have revenues, etc. But that's fine. That doesn't mean that you should go and buy the stock, right? It's growing fast. They have high gross margins, right? Some of them 80 to 90%. It's typical in a software business, right? But does it mean that you have to go buy them? Because you could still pay quite a lot of money for the privilege of owning these shares. Now let's look at this graph. Basically talks about some of those SaaS companies that are growing fast. And you can see that you're playing, in some of these ones, you're paying up to 100 times your revenue. The Snowflake, the company cloud data warehouse company that went public only a few weeks ago. You have Zoom. It's 50 times next year's earnings. I think if you just look at this year's earnings, it's probably close to 100 as well. So that's 100 times revenue. I'm not talking about earnings, right? Because some of these guys, for example, Snow doesn't have any earnings, and that's understandable because they're a fast-growing company. They will take all of the profits, gross margins they have, and they reinvest in the company. That's okay. But 100 times revenue, that's quite a lot, huh? Because historically, it's quite a lot. If you heard of Buffett, most of you have, and I've read some of his books on value investing, and there he talks about, as an investor, you have to look at, or you ask for an investment return of around 15%. Okay, so what does that mean? That means you, as an investor, you are willing to pay 7 to 10 times free cash flow, right? The free cash flow is the amount of money that you can get out of the business, right? So you take out all your sales and marketing, you take all your general administration costs, any other operating costs, you pay the taxes, and what is left over, you can actually take out of the business. Is called free cash flow, right? Without jeopardizing the business, right? So you invest what you need to invest in the business, and what's still left over is called free cash flow. So for a 15% return, you can pay 7 times or 10 times maybe. That you compare that to 100 times. So there's quite a difference between the valuation metrics that Buffett was prepared to pay a few years ago versus what investors are willing to pay today. That doesn't mean to say that the investors today are wrong. They are not, because some of the underlying things have changed. There was no 90% gross margins during Buffett times. I don't know, maybe insurance, but it was not 90%, right? So the brick and mortar business do not have that type of gross margin. No, they are growing at that incredibly fast pace. Okay, but it's still too good to find out, to know what the differences are. So basically, the stock market is basically a reflection of the future expectations that we have. Today, a company might grow 100%, but there is no guarantee that it's going to carry on forever, right? As the company gets bigger, the growth forecast. I mean, it cannot still double when it is, let's say, $1 billion company, like when it was $100 million company. It just becomes harder and harder. So it's up to us as investors to say, okay, what are the probabilities? One, that the particular company that you're investing in is going to end up being the market leader. So if you think a company is going to be the market leader, then it's possible that it can meet the future expectations. But in some of these areas, right, there is a lot of competition as well. Okay, if you look at, for example, one of these companies, let's pick Team, right? Team, this is Atlassian, which is a productivity app, right? So the Team is not only the one company that, Atlassian is not the only company that is doing office productivity. There are several other companies doing productivity, so office productivity software. So how do you know, for example, the Team will become the market leader? If it doesn't, and if it doesn't have that, I would say what you call a moat, business moat, or a competitive advantage over its competitors, I think the gross margins will come down because you'll have to spend more on sales and marketing, etc. Right? Versus if you're the only player or having a unique proposition to the customer. Okay. So let's look at one of these companies as well to see what happens when you have such high expectations, right? What if the expectation versus reality changes even a little bit? What happens, right? So the underlying, message that I want to share with you is that these high valuations can lead to very high volatility. Let's do a case study. A company called Fastly, right? It's for those of you who don't know Fastly, it's a company that provides content delivery network services and edge computing services. These are basically, I would say, plumbing of the internet. Okay, so if you want to, let's say, have a website running from the US and somebody in Australia is going to your website, you want to make sure that the user will immediately be able to access the website. Like, he doesn't have to wait around for the information to travel from your server to the client. So they distribute the content across the world, and so that it takes the shortest path to the user. I mean, it's the same for Netflix and Disney Plus and all of these video content providers. They store the content in many locations in the world to make sure the video content is delivered really fast to the customer, right? So, long story short, this company was growing at a compounded annual growth rate of 45%. And if you look at the graph here, in August, in this year, it went from $14 to $126. If you take the lowest point and the highest point, that's about 9 times, right? So you could have got a 900% return on this company if you had invested in the right time. So, and what's happened then? So that was great, right? And just a couple of days ago, Q3 revenue forecasts were adjusted by the company from 73 million a quarter to 70 million. So the small downward adjustment, right? About a 4% adjustments. And if you look at what has happened to the stock today in a couple of days, the valuation of the company has dropped by 40%, right? So this 4% revenue drop had no bearing on the balance sheet of the company. Absolutely none. There was no material impact on the company, just 4% downward advancement of the revenue. That was it. They got in 3 million less than they were supposed to get. But the stock market, the stock went down by 40%. So that is the kind of volatility that you will get when you have such high expectations. Huh? That's really the takeaway. I mean, it could be, the market could go up or higher. Either way, I think as investors we need to be very, very mindful of the wild swings that we're going to get in the next few months or years if the valuation stays like that. Right? So thank you for watching. With that message, I'll leave it there. I invite you to join the voyage with us. Please like and subscribe. It will help the channel quite a lot. Thank you very much and see you in the next video.